of keeping markets open and maintaining and preserving the economic benefits of open markets and rules-based global trade could lift sentiment, lower trade costs, support growth, and help ease inflationary pressures. Persistent inflation remains another key risk. Goods price inflation ticked up at the beginning of the year, primarily due to rising food prices, while service price inflation has remained relatively high. Inflation expectations by households have moved up in some countries, particularly the United States, likely related to an increase in expected costs for imports. Higher inflationary pressures would require monetary policy to remain restrictive for longer, raising borrowing costs and slowing economic activity. So the key policy priorities in this context: constructive dialogue to ensure a lasting resolution to current trade tensions, prudent monetary and fiscal policy, and ambitious structural reforms to reinvigorate longer-term growth. In relation to the higher trade policy uncertainty and tariffs over the past few months, our key recommendation to all governments is to engage with each other to address issues in the global trading system cooperatively, to talk the issues through among market-based democracies and beyond with any partner countries around the world prepared to engage in good faith conversations about how best to make the global rules-based trading system fairer and work better for everyone. The OECD is in many ways a perfect platform for some of those very important multilateral conversations. And to put some numbers around the opportunity, according to our analysis, a broad-based global decline of tariff rates by 1.5 percentage points could boost global GDP, could boost GDP by 0.2% in G20 advanced economies and almost 0.3% in G20 emerging economies within 3 years, while also helping to bring inflation down. The OECD's unique data analysis, standards and tools in areas ranging from market-distorting subsidies to the importance of competitive neutrality, sound corporate governance of state-owned enterprises and responsible business conduct can provide important input into key bilateral and multilateral conversations about improving global trading arrangements. Monetary policy will need to be carefully calibrated. Central banks should remain vigilant in view of the high policy uncertainty and the potential for higher trade costs to affect wages, prices and demand. If inflation expectations remain well anchored and trade tensions do not escalate, policy rate reductions can continue in countries where inflation is projected to moderate or stay subdued. In our projections, we expect continued policy rate reductions in several large OECD economies, including the euro area, the United Kingdom and the United States. On fiscal policy, governments need to focus on rebuilding fiscal space and on preserving room for future spending pressures. Last year, public debt in the OECD stood at 112% of GDP, up from 73% in 2007. And debt servicing costs are on the rise. Our global debt report released in March shows that government interest payments increased as a share of GDP in about 2/3 of OECD countries last year, reaching 3.3% on average. In parallel, defence spending requirements have been increasing in Europe and elsewhere, though it is still below countries' own targets, forcing difficult choices about the pace and the composition of fiscal adjustment. Pension and social policies, for example, the two largest items in government budgets, could be made more effective through better work incentives for older workers and targeting of social benefits. While responding to the immediate economic challenges, we must also lay the groundwork for stronger growth prospects in the medium and long term. Potential Per capita growth for the OECD this year is estimated at 1.3%, which is down from around 2% in the 1990s. Job creation has been a central driver of growth in recent years, while productivity growth and investment have both declined significantly. Ambitious structural reforms are key to unlocking higher investment and productivity, ensuring they once again become stronger drivers of growth, including by boosting competition and reducing barriers to firm entry, lowering regulatory costs for businesses, reducing policy uncertainty, improving